Hey traders, so in this video of the Forex Trading for Beginners series, we're going to look at your technical analysis technique. So that's your charting analysis. In the previous video, we looked at the charts, we looked at what they give you, the sorts of information you need to look at. But what we need to do right now is actually take a look at how is it that we're going to decide which way is price going to go. And once we understand which way price is going to go, then we can start looking at opportunities for getting into the market to actually derive our profits. Now, the best technique for trying to figure out which way the markets are going to go is ultimately looking at support and resistance. It's probably the oldest form of technical analysis, and it's one of the things that every single trader in the world uses, whether you are a retail trader, a home trader, sat here watching this, or a trader in one of the big banks or hedge funds, you use support and resistance in one way or another. And I know this because I do this myself, and I have lots of friends and acquaintances in the industry, professional traders that are making money day in, day out, and they all use this as well. Now, the way that they come to their trading decisions may be a little bit different. So some might be looking at fundamentals to derive their directional bias. And then once they've got that directional bias, they then go and take a look at the charts and they'll look at support and resistance for their entries. Whereas you have other traders who are purely sort of technical traders. They don't look at the fundamentals, and instead they look at the support and resistance and the swings in the market to get their directional bias, and then they also look at it for their entries. But what we're going to do in this video is we're going to break it down. So this first video here, we're going to look at the how we decide which way is the market going to go, and then in the video after this, we're going to go and take a look at, okay, so now we understand where the market's going to go, how are we actually going to get into our trades? Okay, so as I said, what we do for this is we will look at support and resistance levels. And the reason that we look at support and resistance levels is that when you're looking to trade, you need to understand where to trade. Okay, because if you understand where to trade, where the action is going to take place from, you can balance your reward to risk ratios so that you get the best bang for your buck. And that is that you can get into the markets with the lowest amount of risk to get the maximum amount of reward. Now that ratio is going to vary from person to person based on your attitude to risk, but paying attention to this information is going to help all of you, regardless of whether you're looking for a 2-to-1 reward to risk, or even if you have it skewed, so you have like a risk that's higher than your reward. You can make money doing that too. But it all starts here with looking at support and resistance. So if we take a look at support and resistance, what is it? Well, support and resistance is ultimately areas on the chart where the price is rallied up to. So it's either, if it's in an upwards moving market, the market has moved up to it, it can't go any further, and then it moves away from it. That's something known as a resistance level. So if we look on this chart here, we can see that the market has been moving up here, and then it gets to a point where it can't go any further and it moves down. And this area over here is what we call a resistance area. So what we can do is we go in there and we mark that area on our charts as an area of interest. So when the price next approaches that level, we can say that we want to trade at that level, okay? So if we kind of go to the right a little bit, we can see that we've identified this level on the 1st of September 2020. The market moves away. The next time the market comes up to that level, look at what happens on the 27th of November. So this is the daily charts. We come up to this level here. It sells off from it. It doesn't sell a lot, but it goes, this level's at 74.17. It gets up to that level and then it jumps back down to 73.41. So you got sort of like 70, 80 pips if you were trading short term that you could have taken advantage of when the market came to this level. The market then breaks through that level. And once it breaks through that level, we then see momentum, okay, carry the price off on its merry way. So we get momentum through this level up here. Once it got through there, it did play with it. You can see here for a little bit of time, the market played with that level, but it did eventually get through. And then the market moved from 0.7413 all the way up to 0.7811. Okay, so nearly, well, pretty much a 400 pip move. that you could have made. And if you're trading a pound a point, not that you would have got the whole thing here, but just to kind of put it in perspective, put it into context, a 400 pip move at a pound a point is £400. At £10 a point, that's £4,000. Now, obviously you don't get in there and you don't get out right at the top. No one does that. But as I said, it just kind of illustrates what's possible if you can identify these areas. And I'm sure you'll agree that identifying that area there wasn't very difficult at all. So now I want to talk about why is it that these levels actually have such an impact on the market? What is the psychology behind the levels? What is it that actually happens at these levels that causes the market to either sell off from it? So if this is the resistance level here, why did the market sell from here initially? And then when it broke through, why was there so much momentum? Well, you have to remember that in the markets, you have, obviously you've got algorithms and things like that, but you also have human beings, and the human beings create the algorithms. If you're an algorithmic trader, there's still a person behind it. And the principles are always going to be the same. And that is, if the market is below a resistance level, so you've identified this resistance level over here, and the market is below that level, then you're expecting it to sell off. So the next time the market comes up to that level, you're going to expect it to sell off, which is what it does. If the market breaks through that level, you're expecting it's like a self-fulfilling prophecy, you're expecting it to rally, to move away from that level with momentum. The why this happens is because of that expectation. What happens is traders cluster their orders in and around these levels. So in a resistance level, there'll be a cluster of orders above this level here, okay? All of these orders will be the traders that are selling the markets, that believe that the market is going to go down, they're going to have their stop orders above this level, or they're going to have more sell orders in the market here to push it further down. Now, if they have their stop orders above this level, what that means is in order for a seller to get out of the market, they have to buy the market, thereby creating demand in the market. So when the price breaks through a particular level, what happens is that you get all of these sellers over here, all of their stop orders will be clustered above this level, which creates buy orders in the market, which is what pushes the market up. Now, in addition to that, all of the bulls in the market, so all of the people that believe the market is going to go higher, they're going to cluster their buy orders above this level as well. So not only do you have the sell orders here, but you're also going to have a bunch of buy orders around here. So the next time that the market breaks through it, if it breaks through it with some momentum, which is what we get here, okay, you're going to have all of the stop orders from the sellers, and then you're going to have a bunch of buy orders above here as well, which is going to create a lot of demand for this particular currency pair, or if you're trading a stock or a commodity. But essentially you have a lot of demand above a resistance level, which is what pushes the market in that direction. Now, sometimes the market isn't going to break through the level. Okay, sometimes it's just going to use it as an area to bounce. And that's what we see here. So here, we can see that the market has sold off and then it's rallied off from a level. So this here is a support level. We can put that in there like that. And now the next time the market comes to it, we can either look for a buying opportunity, or if it breaks through it, we can look for a selling opportunity. What happens here is that the market doesn't actually break through this level. It peaks below it very, very slightly, but then it rallies off from it. So what you would do in this situation is you would look at this cluster, okay, of candles over here that are just moving sideways, and you would put in a resistance level above here and say, I'm going to buy if the market breaks above that level. What's happening here is that instead of the stop orders getting triggered below this level, so this is a level of support. So what that means is all of the buyers in the market here, they would have their stop orders below here. Now, to get out of a buy position, you need to sell the market. So that would be sell orders. But they didn't actually get triggered here. What happened instead is that the buyers were so confident about the way that the market was going to go was that there are more buy orders around this area here, which creates demand for this particular currency pair. And the way that you would trade this is essentially you'd have this area, this range in here. You could then get in when the market breaks above the range with your stop below the low and go for, one-to-one risk to reward, if you like, which would have netted you what do we got here? 0.7666 all the way up to 0.7875. So you're looking at sort of 210 pips in that little move there. The next time the market comes down to this level, we're expecting something to happen again. Now remember that it's important to understand that we don't just trade because the market is at that level. We still have to wait for price action when it gets to that level. So what we see here is the market does break through here, which is great. It then tries to rally back up above. It doesn't manage to do that. It then breaks down from that level, and we would take a break on a break of this low here. Okay, so once the market's kind of said to us, okay, I'm looking to take the trade here, I'm looking to go lower, we wait for that little bit of extra confirmation. We can get involved when the market breaks through that level, stop above the highs like that, 1-to-1 reward to risk ratio, you'd be out very, very quickly within just a few candles there, you'd be out taking your profits. And that is based on nothing more than support and resistance levels. But before we wrap up this video, I want to show you that they work. I haven't just picked something specific here where just to prove my point. This stuff works all over the chart. So if we go back here, if I zoom out, you can see that every time there's a big level in the market. So looking at this area here, this was an area of resistance. The market came into play over here. It came into play again over here and over here. So every time the market approaches that level, something happens, even up into the present day. So this level here, we could have identified it on the 2nd of January 2020. In fact, it goes further back, but let's assume 2nd of January 2020. There would have been opportunities to trade that even in June, July of that year, September, October, and then coming back to the present day, so the 6th of December, just gone, so that's about a couple of months ago there. And then even as close as last week, this level came into play. So when you're looking to decide which direction you want to trade in the markets, when you're looking to identify, okay, the areas that you want to take trades from, you have to look at support and resistance levels. And you have to take a view that price above a level means that you're looking to buy the market. Price below the level means that you're looking to sell the market. In terms of the way that you actually take your trade, you can look at the way that I've shown you here. I'm going to back that up in the next video. So we're going to look at entry techniques a little bit more closely, or you can use your favorite technical strategy, one that you find out there on the internet, on a forum, or even if you watch my free masterclass, which I'll post beneath this video here, you can use that too. Essentially, what you want to do is you want to identify these levels, and then once the price gets to these levels and reacts to these levels, you then implement your favorite strategy to profit from the markets. And hopefully you've seen here that once you can identify support and resistance levels, it gives you a great opportunity to identify areas on the chart which are going to give you high probability trades, because the markets, they have a memory, and these things play out again and again and again and again. Even looking at this over here, let's take a look at this level that we identified on the 11th of December 2018. The next time the market gets to that level, on the 15th of September 2020, what happens? The market sells off from that level. Okay, so I hope you enjoyed this video here. I hope this is all starting to really fall into place and really start to make sense. If you have any questions, please feel free to post it beneath the video. Make sure that you subscribe to the channel if you haven't already done so. A lot of you think that perhaps you already have, but if there's a little red subscribe button beneath the video here, it means that you aren't already subscribed. So just hit that subscribe button and also hit the bell so that you get a notification as and when I release these videos. Thanks so much for watching, and I'll catch you in the next video. Take care now.